Welcome back to the deep dive. Today we are really opening the hood on the engines of cross-border institutional capital.
We are.
We're looking at these high-octane investment vehicles that are, standardizing how massive amounts of money buy up real estate all across Europe. We're talking Berlin logistics, residential powers in Paris, you name it.
And this is a deep dive for anyone who's financially curious. Our mission today is to give you a necessary shortcut into understanding the Luxembourg Master Fund SICAV RAIF.
That is a mouthful.
It is a complex name, but it's become the default choice for institutional investors, large family offices, and entrepreneurs who need yield and diversification across Europe.
Okay, so let's unpack that right away. Before we get into strategy, we have to cut through the jargon. What is a master fund SICAV RAIF? Why this specific combination of letters?
Right, so it's a Reserved Alternative Investment Fund, or AIF, that's the first part. And it's set up in the legal form of a SICAS.
A Société d'Investissement à Capital Variable.
Exactly. And that combination is crucial. The RAIF part pulls the whole thing under the AIFMD framework. That's the Alternative Investment Fund Manager's directive.
Which means it needs an external regulated manager.
Precisely. An AIFM.
Okay, stop me right there. A SICAV is a variable capital company. Why does that matter so much when you're dealing with something as illiquid as real estate?
Oh, it matters hugely. It's all about scalability and speed.
How so?
Well, with a fixed capital company, changing your capital size is a whole legal process. With variable capital, the fund can onboard or, offload massive amounts of investor capital really quickly.
So you don't have to go through constant legal or notarial hoops every time you get a new billion-dollar commitment.
You've got it. That flexibility is just essential for these large, cyclical real estate funds.
And that speed, that flexibility immediately ties into the competitive advantage, doesn't it?
It's the core reason sponsors choose the RAIF. I mean, the regulatory burden is shifted to the AIFM. It's not on the fund itself at launch.
So it doesn't need pre-approval from the CSSF, the regulator.
Correct. And because of that, it has a remarkably fast time to market.
I've seen figures like 30 to 40 days between concept and the first closing, which sounds incredible.
It is.
To put that in perspective for you listening, what's the usual timeline for a traditional fund that does need that full CSSF pre-approval?
Oh, you're talking 6 to 9 months. Easily.
6 to 9 months. In a fast-moving market, that's an eternity.
It means losing an entire pipeline of assets. The speed of the RAIF lets managers capture those opportunities almost instantly. They can hit the market exactly when they need to.
So who needs that kind of speed? We're talking about massive institutional players, right? Which brings us to the investor profile.
Precisely. The whole regime is designed for them. Institutional investors, family offices, pension funds, sovereign wealth funds.
It's built for complexity.
It is. And there's a high barrier to entry. The minimum subscription is usually set at 125,000 euros. That automatically ticks the well-informed investor box.
Okay, so if the fund bypasses that CSSF pre-approval, and the AIFM, the manager, takes on all that regulatory work, where does the oversight actually go? Is the AIFM basically the new regulator?
That's a great way to put it, actually. The focus shifts from pre-approval of the fund to continuous oversight of the manager.
I see.
The AIFM is authorized, it's strictly monitored, and it has to run the RAIF according to all the AIFMD rules on risk, on leverage, on compliance. So the speed doesn't mean no regulation.
It just means the regulation is dynamic. It's enforced by the manager in real time.
Exactly, not statically by the government at the start.
That feels like a powerful trade-off. Institutions get speed, and regulators know a sophisticated regulated entity is always at the wheel.
It is.
So let's go a bit deeper. Beyond speed, what makes this structure the ultimate cross-border vehicle for European real estate?
This is where we get into tax efficiency and market access. Fundamentally, the RAIF acts as a tax-neutral conduit. Yeah. If it's structured correctly, the fund can avoid economic double taxation, and it can distribute returns without a Luxembourg withholding tax, which is absolutely essential when you're pooling money from global investors.
So the goal isn't zero tax, but one single layer of tax, either at the asset level or the investor level.
You've got it. It just standardizes the flow of money. And that flow is massively boosted by the AIFMD marketing passport.
Ah, the passport. Tell us a bit more about that.
Well, because the whole structure is managed by that authorized AIFM, the fund automatically gets this marketing passport.
And this is what turns a local Luxembourg fund into a pan-European fundraising machine.
It really is. The AIFM just notifies regulators in other countries, and boom, you get access to professional investors across the entire EU and EEA.
So you don't have to do separate private placements or registrations in 27 different markets.
No. It cuts the administrative costs of fundraising exponentially. It allows sponsors to solicit money from this huge, multi-country pool of capital almost instantly.
Which ultimately drives down the cost of capital.
Efficiency realized through regulation.
Okay, let's shift to the architecture, the plumbing. How does the money actually flow from this central master fund down into, say, a new office building in Amsterdam?
So we use what's called a master feeder architecture. Just think of the master fund as the central corporate treasury. It holds the big, consolidated, diversified portfolio.
Okay. And the feeder funds.
The feeders are like tailored bank accounts that feed into that treasury. They let the sponsor attract very specific types of capital.
So one feeder might be for a sovereign wealth fund that only wants safe core assets.
Right. And another feeder could be for high net worth investors targeting much riskier, opportunistic returns. All that cash gets pooled into the master fund, which then does the actual investing.
And that means the manager can launch new strategies without having to rebuild the whole governance structure every single time. It's about economies of scale.
Precisely. Now, under that layer, you have the assets themselves, and this is where the local special purpose vehicles, the SPVs, come in.
Right, because real estate is all local laws, local taxes.
It is. So the master fund invests through these local SPVs in, France, Germany, Spain, the Nordics, wherever.
And that use of local SPVs is critical for risk management, isn't it?
Absolutely. It allows for the ring fencing of local liabilities. If one project in Spain runs into trouble, that risk is contained in its own little SPV.
It doesn't contaminate the entire multi-billion-dollar master fund.
It can't. And it also lets you structure debt very effectively right at the asset level.
So with this layered architecture, the range of strategies must be enormous. What are the typical risk and return profiles you see in these funds?
We generally break it down into three big categories. First, you have your core and core plus strategies.
The safe stuff.
Pretty much. We're talking stabilized, high-quality, income-producing assets, brand new logistics hubs with long leases, that kind of thing. The target is modest, reliable annual yields, usually around 3.5% to 5%.
Low-hanging fruit for pension funds.
Exactly. Then you have the high-risk, high-reward bucket that's value-add and opportunistic.
This is the heavy lifting.
It is. Repositioning distressed buildings, ground-up developments, it requires extremely active management, carries way more risk, but you're targeting higher total returns, an IRR of, say, 8% up to over 15%.
And the middle ground.
That would be the real estate credit and hybrid strategies. This is where the fund isn't buying the property, but it's providing the debt.
So lending to other developers.
Yes, senior loans, mezzanine financing. The returns are a bit lower than pure equity, targeting maybe 6 to 9% a year, but you often get those nice fixed interest payments.
I see. And I assume all of these can now integrate ESG criteria.
Oh, absolutely. It's increasingly a demand from institutional investors. These strategies can and do fully embed sustainability mandates.
Okay, let's circle back to trust. For a listener who, runs a family office or works at a sovereign wealth fund, what specific governance piece gives them the most confidence that their capital is protected?
The confidence really comes from the triangulation of mandatory independent parties.
A triangulation.
Yes. You've got the AIFM, which is the operational brain portfolio management, risk, compliance, all of that. But the two critical external checks are the depositary bank and the auditor.
Explain the depositary's role.
The depositary is mandatory for all these funds. Its legal job is to safekeep the assets, monitor all the cash flows, and perform operational oversight.
So they're a gatekeeper.
They're the gatekeepers. They have a fiduciary duty to the investors to make sure the AIFM is following the rules and to flag any potential problems.
That sounds like the true independent watchdog in the system.
It really is. And then, of course, you have the independent auditor reviewing the financial statements every year, usually under very rigorous standards like IFRS.
So it's that combination, the AIFM's internal compliance, the depositary's asset safety checks, and the auditor's financial verification.
That's the package. That's
Yeah.
what makes the structure so attractive to global institutional capital.
This really is a masterclass in combining speed with efficiency and very robust governance. So to summarize the core takeaway for you listening.
The structure is just the perfect vehicle for real estate managers who need to scale their strategies across many EU countries very, very quickly.
And for the big investors, it's one streamlined access point for a professional pan-European real estate allocation.
It just transforms what would be a complex, scattered mess into a cohesive, centralized financial platform.
So the Luxembourg Master Fund SICAV RAIF, it's not just an acronym, it's really the operational solution to a huge problem in European real estate.
It's a structure that is absolutely built for scale and efficiency.
And that leads us to our final question for you to think about. When we consider that institutional capital now has this unprecedented speed to deploy across the entire EU, allowing managers to acquire assets much faster than local players, how does that concentration of power and efficiency ultimately influence local housing and commercial real estate prices in cities like Berlin, Madrid, or Dublin over the next 5 years?
That's the big question. It's definitely something worth considering as you watch new developments and big asset deals taking place near you.
A fantastic dive. Thank you.